Yeah, and the first thing you mentioned is very interesting. The context where I got to the model is indeed very different than today. So it was in the deepest of the bear market. We just went down from 20,000 to what was it,
I think
three and a
three.
half
Yeah.
thousand something. It was really uh, yeah, very deep into the bear market, and actually everybody was talking about going to 1,000 even further. So there were people all around me very negative. The press was negative,
Yeah.
and yeah, so those are the exact moments that you want to have a quantitative model, that a sort of compass that leads you into the right direction. And for me, it was very clear at that time that that going further to $1,000 was not going to happen. So it was a bold move. With hindsight, I was, I guess, a bit lucky as well that it was that period, of course, that I came up with it. But yeah, it was very different. So yeah, the model is mathematical, statistical, if you will, but it's also very, very simple. And I deliberately made it that way. So the whole idea is that it's the scarcity of something that drives the value. That's true for real estate. That's true for gold. There's That's true for Bitcoin. And actually, there is not much. There are not much valuable or very scarce valuable things in the world
Hmm.
besides gold and real estate and Bitcoin and silver. There's really not that much. Maybe art, maybe diamonds, but that's
Sure.
it.
Yeah.
And so the second question then is, how do you quantify scarcity? How do you measure it? How do you put a number on it? And of course, that's where the idea from the gold market community came, to measure it in stock to flow. So there, and stock to flow is also very simple. It's how much of an asset is there above ground, um, that's the stock, and how much is produced every year. And then you just divide it. So for gold, it's 60. Stock to flow ratio is 60. So there's 60 years of gold production above ground, and that's very. You have to think about that. For example, oil has a stock to flow of a quarter year, 0.25 years, because all the oil is used right away. It's not
Right.
stored. It cannot be stored. It's very difficult to store. There's some strategic military reserves, but
Sure.
the oil is used. And if the stock of a thing is less than the yearly production, then of course the power is all with the producers. And that's what you see with oil. You know,
Right.
the OPEC and all the cartels are very powerful, and it is very difficult. And Seyfried Ammous writes about this very eloquently in his book, the Bitcoin Standard, which is a must read
Wonderful.
for
A
every
must read. Yes.
a must read. And uh, yeah, so he writes about how difficult it is for an asset, for a thing to move beyond the stock to flow one number. So oil has 0.25. There's also platinum and palladium, for example, which most people think of as very scarce assets. They are not actually. They have stock to flow ratios of around one or less than one, because all the platinum and palladium is used in cars. Uh, so for an asset to be hodled, if you will, to be saved and not used in the industrial things, it yeah, it has to be seen as sort of money or something. And that happened, of course, to silver.
Right.
It happened to gold. It happens to Bitcoin now. It certainly happens to real estate because,
Hmm.
well, what else do you put your money in
Yep.
these days?
Of course.
And art is, of course, also a very, very interesting store of value.